So let's talk about 2023 year-end tax tips. So the first strategy that we're going to talk about is S-corp filing. So this is a big one because a lot of small business owners want to immediately jump on the S-corp bandwagon because there are articles, there are videos, there are blogs and different things out there that say an S-corp is the way to go if you're wanting to reduce your tax liability. Well, listen. You can absolutely reduce your tax liability by being an S-corp, but there are stipulations. There are things that you need to know about. For instance, the shareholder stipulation that's there, or the reasonable compensation that is required as an S-corp. Can you be an employee and a member of the LLC that is supporting the S-corp, or can you be a C-corp? Can you file as a C-corp and then have the S-corp election? Like, there's so many different moving parts, and so you want to make sure it's done the right way. But let's just say you've done your research, right? And S-corp sounds like it is going to be the best bet for you. But wait a minute, it's the end of the year. How in the world do we do that? How do we meet that reasonable compensation requirement? Well, here's the thing. There is a revenue procedure, and I'm not going to give you the number because you're going to start putting that everywhere and thinking you're a tax expert. But here's the thing. There is a revenue procedure that you can reference that says, hey, listen, according to this RevProc, I am an S-corp and I've been acting as an S-corp. Here are the things that I've done. And you can actually make a late S-corp election. So that is something that's out there. So what's so big and great about it? Well, you escape the self-employment tax requirement as an S-corp. Now, because you have the reasonable compensation requirement, you're still going to pay in that Social Security and Medicare that's typically coming out and is reflected in your SE tax. However, you're able to do it in a way that is a business deduction for you, and it increases your expenses, which reduces your profit, which reduces your tax liability. So there's kind of a trail that goes there. All right. So S-corp election, but this is definitely something that you want to work with your tax planner on because there are requirements and stipulations, as I mentioned, that you need to be aware of. All right. Before you go that route. Number 2, harvesting losses. So listen, the market has been all over the place. It's been up, it's been down. Depending on what you have, what purchases you made, you may be sitting at a loss right now in your portfolio. And while that may stink, that loss may help you in terms of reducing your taxable income and reducing your tax liability. So that is absolutely a strategy that you can utilize to reduce your tax liability. So right now, the way those losses are sitting in your portfolio is as an unrecognized gain, an unrealized gain, okay? So that means that basically on paper, you have a loss. Well, you can't really take that loss until you sell that stock. So let's just say you bought a stock at $100. It's now worth $50. Well, you have an unrealized loss of $50. Well, until you sell that stock for $50, you can't really do anything with it. Go ahead and sell that stock. Now you have a realized loss of $50, and you'll be able to take that against your income. So that is another way that you'll be able to reduce your tax liability. Hey, I want to take a quick break here and say, listen, if you haven't already, make sure you like this video, subscribe to the channel. We got a bunch of information that's going to be coming out, and so I want to make sure that you are in the loop. All right, number 3, we're talking about retirement contributions. So here's the thing with retirement plans within your small business. They can be a little bit tricky because you want to make sure that you're not opening or starting up a plan where there's a requirement to make sure that everyone within your company is going to be receiving the same amount of percentages and contributions and all of that. So this is something where you definitely want to make sure you're working with a tax planner that has access to financial planning resources, or someone that can open up a SEP or an individual retirement account or a 401k or something like that, because you want to make sure this is lined up properly. And listen, we're right here towards the end of the year, so you have very little time to get this done, but it can be done, and you can make those contributions. And depending on how they're set up, those contributions can reduce your business profit, which is going to be absolutely wonderful for you. All right, strategy number 4, estimated tax payments. So here's the thing. None of us want to pay taxes, okay? We don't want to pay more than we have to as business owners. I saw an article the other day and it was pretty funny. It was like, we're taxed on the money that we receive, and then we go to the store and we buy something and we pay taxes on that thing. And then we live in a house and we pay taxes on the property that's there, and then we sell the house and then we're taxed on the gain that's there. It's just like taxes are everywhere, right? So how do you avoid that? Well, you plan for it, okay? But one of the strategies that we're talking about now is estimated tax payments. So here's the deal with estimated tax payments. This is not a strategy that I love because it involves you paying the tax. However, sometimes it's more beneficial to go ahead and just pay the tax versus spending all this other money and reducing your available cash and your capital just to avoid a smaller percentage in taxes that have to be paid. So sometimes it absolutely makes the most sense to just pay the estimated taxes. Here's the other thing that you need to note. If you filed a tax return last year and you had a balance that was due, then there may be a minimum amount of estimated taxes that you have to pay for this year. So you want to make sure you connect with your tax preparer and your tax planner to see what that number is to make sure that you meet that minimum requirement, because if not, you will have penalties and interest. So we absolutely want to avoid that. It's bad enough we're paying the tax. We don't want to have to pay penalties and interest. So make sure you're asking about that. The fifth option, and I was very hesitant to mention this option because this seems to be where everyone just kind of flocks and says, this is my strategy. This is how I'm going to save on taxes this year. But it's purchasing depreciable assets. All right. Listen, in your business is growing. There can absolutely be a need for new equipment. That's fine. That's great. However, don't utilize that as a strategy. At the end of the year, you're just going to tie up all your cash. You're going to go into all of this debt and utilize all this credit because you're trying to save X amount of dollars in taxes. Again, see number 4, where sometimes it's easier to just pay the tax. However, purchasing depreciable items can absolutely be a tax saving strategy. Listen, you're at the end of the year and you recognize that you do need additional equipment for your business. Go ahead and make that purchase. It's going to help you. You need the equipment and it's going to have a tax benefit. So there's no harm in doing that whatsoever. Here's one thing to note. Okay, of course, you can take advantage of Section 179 that allows you to take the deduction, but for bonus depreciation, we are no longer in that era of 100%. Okay, so now we're down, so that's moving, and that's going to continue to reduce over the course of the next few years. So don't go buying that equipment thinking you're going to be able to deduct it 100% under bonus depreciation rules. That is no longer the case. But again, that is absolutely a strategy that can be utilized, but it needs to be utilized with some guidance. Okay, don't just go out there buying equipment thinking you're going to depreciate it. Here's another thing. If you are a business owner and you're looking to make purchases because you're trying to reduce your tax liability, do not purchase assets that do not depreciate. Okay, so don't go out there buying land thinking that that's going to be a huge benefit for you, because it's not. Land is not depreciable. So you cannot take the deduction. Now, if the property is improved, okay, you have a building that's built onto it, now you're talking. Okay, now we can depreciate that. We can also do some cost segregation studies. There's all kinds of wonderful things that we can utilize, some complex strategies that we can utilize. But please don't go out buying a bunch of land thinking that you'll be able to depreciate it. Now, there are other things that you can do. You can say it's farmland and all of that. And you can put cattle on there, but there still needs to be some other things that need to happen. So, guys, listen, the best option for you is to make sure that you're planning before the year ends. Work with someone throughout the year, gather the resources and the tools to make sure that you are planning for your taxes so that now at the end of the year, you know where you stand, you know what your balance is going to be, and you have a plan to mitigate those balances. Listen, guys, I hope this information has helped you. Please like and subscribe, but also leave down in the comments. Let me know if there are other strategies that you utilize that help you save on taxes. You're going to be letting me know and everyone else that's viewing. So this is going to be great information. But then also let me know if you guys have any questions about any of these strategies that were mentioned or other strategies that are out there. All right, have a great rest of the year. We'll see you next time.